Very good afternoon. Let me just change my screen. Sorry. Let me just change this around so you got the right screen. There we go. That's super. A very good afternoon. Good morning. Hope everybody had a nice weekend. Welcome to Live Market Analysis FX Look Ahead with myself, Giles Coghlan. I do hope everybody's well. Really looking forward to taking us forward this week. Just want to make sure we're fully aware of the major narratives. There's a lot of changing dynamics going on in the market. So I want to start off the session ensuring we know exactly what the key narratives are and what to look for. As folks are signing in, don't forget, as we look at different entries, exits, the whole idea of this webinar is it's an educational webinar. The idea, you look over my shoulder, someone with a professional trading background, and you see how I go about making trading decisions. The key thing to realize, it's not a signal trading service, and it can't be, because market dynamics are constantly changing, etc., etc. This is just a way of understanding the markets. Now, big event this week is going to be Fed speak and US inflation data. I'm going to put that into the current context for us so we can see why that's so important. But another key narrative to look out for is that of banking stress. Now, there's been news that First National Bank has bought Silicon Valley Bank's assets and will take responsibility for its depositors as well, and that has lifted sentiment overnight. So don't forget, in the current environment, that we can expect to see positive banking news to lift sentiment. Why? Because the banking sector was a significant factor of stress for financial markets. We had Silicon Valley Bank, First Signature Bank, then we had Credit Suisse Bank having troubles in the UK. Sorry, in Europe rather, and then UBS have agreed to take over Credit Suisse, and investors looked at the banks under stress and said, oh no, it's the global financial crisis all over again. And so we had significant equity market selling. That has stabilized. We had the Fed and the FIDC supporting the Silicon Valley Bank and First Signature Bank. We had the Swiss National Bank supporting Credit Suisse with liquidity. We have had other European countries and the UK have said that they don't expect significant stress in their banking sectors. And the Fed, UK, Germany, Switzerland, all expressing confidence in their banking sectors. So that has just lifted sentiment. Now, we'll look at that in a minute and see how that's impacted markets to start the session. But remember, there's a very helpful chart that the team over at Financial Source shared not too long ago, and it's very helpful. If you look at the orange line, that was after Jerome Powell's semi-annual testimony, which is only a few weeks ago now. That was the path of US interest rates. The white line was the path of US interest rates maybe like a week ago. We'll look at that now and see that's even dropped lower. And so what we've seen a rapid repricing in bond markets. Bond investors are expecting a coming US recession, and bond traders are essentially betting that the Federal Reserve is going to have to cut interest rates at least twice this year. So let me show you what's going on. Look at this. This is the current short-term interest rate markets with the Financial Source interest rate tracker. Now, currently, interest rate's 4.875. Now, short-term interest rate markets are saying that they're expecting this to fall down to 4%, 4.17%, around that region by the end of the year. So what bond traders are doing, and there's an old saying in the market, you know, the bond market is the truth, because bond traders tend to be medium-term investors, and they're looking ahead, and what they're seeing is, oh no, the US is heading into a recession, so the Federal Reserve is going to have to cut interest rates at some point over the next few weeks and months. Now, those of you who are shrewd amongst you will realize, well, that's exactly the opposite what the Federal Reserve said. The Federal Reserve, and I'll just pull up, you know, what the Federal Reserve said at their meeting just last week. They said they're not expecting any interest rate cuts, right? this year. So here's the Federal Reserve. This is their dot plot. So what they're saying, you see how this is for 2023? That's a median of 5.1%. So they're saying, the Fed's saying, we're not going to cut interest rates at all this year, and we expect a median rate of 5.1%. Some, up to 5.75%, 5.875%. Some as low as 4.875%. But none of them expect any interest rate cuts this year. But short-term interest rate markets are saying, oh no, Federal Reserve, you've got it wrong. We're expecting, 2, 3 interest rate cuts this year. Right, now you're in tune with what's going on. So which of these groups is right? Is it bond traders, are they correct? And is the US heading into a recession? Or is the Federal Reserve correct? The high inflation is going to be stickier and it's going to result in higher interest rates, staying higher for longer than the market's expecting. Now, to be clear, this is exactly where we were pretty much at the start of the year. As bond traders saw a coming recession, but the Fed said we're not cutting interest rates. So we're back kind of to where we started. Now, on the back of that, stress, we've seen significant stress in equity markets. Now, as I started, we're seeing positive sentiment today because there's been some positive banking news. Right, there was a bit of a wobble on Friday. Concerns about Deutsche Bank in Germany. German's chancellor came out and said there's no problem with Deutsche Bank, very profitable bank. And that positive sentiment news regarding the First Republic Bank taking on the Silicon Valley Bank assets and deposits, that's just boosted sentiment to start the week. So we now have the key narrative to be aware of. Which one's right? Is it the Federal Reserve? And will there be no interest rate cuts? That will be negative for stocks. Or is it short-term interest rate traders? There's going to be 2 or 3 interest rate cuts this year. That's positive for stocks. As long as there's no major problem with the with any banking sectors, then you'd expect stocks to gradually sort of grind higher. So here's the first thing to be aware of this week. If we see any banking news that's negative, expect that to harm sentiment and to send stocks sharply lower. So be very, very aware for that. If you're struggling to know what's going on with sentiment, keep an eye on the VIX. With volatility pushing lower, that's positive for the underlying asset. And this is the volatility for the S&P 500 index. And all this shows you is the ratio of put options that are being purchased for the S&P 500. And a put option is when a trader or investor is expecting the S&P 500 to move lower, so they might hedge their longs by buying puts. So when this ratio rises, it's traders expecting downside in equity markets. So you can see here, overlaying the S&P 500, rising VIX, falling stocks. Falling VIX, rising stocks. Rising VIX, falling stocks. Rising VIX, falling stocks. What have we been seeing recently? We've been seeing the rising VIX, all these banking woes, falling stocks. Now we're seeing falling VIX, rising stocks. So if you're ever uncertain during the week, think, oh, I wonder what the market thinks of that latest news, just call up the VIX. It will let you know, okay? And it will flag up to you whether there's a problem, whether there isn't. So that's positive sentiment. WTI, Brent crude pushing higher on the session. That's on the positive sentiment. Copper also pushing higher. Gold just pulling back a little bit from its very high elevated levels, similar with silver, but broadly expected upside in gold and silver with the fall in real yields. Bonds just pushing up higher in the session today. No particular drivers there. And the major currency pairs are being impacted by the dollar. Mild dollar downside, just marginally supporting the major pairs higher. Now, let's look at the dollar. Now, the dollar index has been tracking lower since the start of the month on expectations that the Fed is going to be less aggressive. So if the Fed are less aggressive, they're going to be less likely to hike interest rates, and that's dollar negative. But if the US heads into a deep recession, we could see some dollar bids pick up on global recessionary fears. So remember, the dollar gains and falls at different times. So if there's a worry about a global recession, the dollar can pick up. And if you think about the logic of that, imagine you're a US investor and you're expecting the globe to grow together. Okay, you're expecting general sentiment to pick up across the world. You think, okay, well, I've got a portfolio of 500 million. I might start investing in countries around the world where I'm expecting growth. So you might think, well, what about Brazil, some emerging markets? You might be looking at investing in South Korea. You might be investing in Europe. And so what do? You have to sell your dollars to invest in all these different countries. So when the world's growing together, you tend to see the dollar weaken. So when markets are expecting easier financial conditions, that is advantageous for dollar flows around the world. But think about it the other way around. When there's a big recession going on, and if that recession is taking place not only in the US, but throughout the rest of the world, what's going to happen to dollars? You're going to think, oh, that investment that I put into South Korea last year, well, I'm not so sure about that now. I want to bring that back home to the US. I want to consolidate my positions. I want to go to cash. And so that will support the dollar, because you'll be converting your Korean won into the US dollar, okay? And all those assets that you had in Korea, you will be cashing back in and converting it to your Korean won, and then you want it back to the US, so you convert it into dollars. So expect the dollar to reflect that global recessionary growth or fear. So if the world's going to be expected to grow together, the dollar can keep falling lower. You can see this key trend line, it's just falling above. That trend line, it's sort of broken below. And if markets are really fearful and worried, then we could see the dollar gain. And remember, we saw that on the 15th of March, going back a couple of weeks, on sort of beginning of sort of global fears that if Europe with the Credit Suisse crisis was going to get into trouble, and the US, then US investors will be bringing dollars home. So just remember that dynamic when you're looking at the dollar moving forward. So right, you now have got the major story, and what we're looking for moving forward is what's happening with US interest rates. Okay, what is the major development going on in the US? We know what short-term interest rate markets are. They're saying no hikes, cuts at the end of the year. We know the Fed are saying no cuts at all this year. So with that in mind, let's now look at the calendar to see what the major issues are. Yeah, hello Abraham, on time. I can't get you clearly. I think everything's okay, Abraham, so I'm not sure what's going on, but everyone else seems to be okay, so I hope you managed to sort out your problem, Abraham. Well done for making it on time. Okay, so let's have a look. The key data this week is going to be Fed speak and US inflation data. We'll also look at what's going on in the euro. So a couple of ECB speakers coming on. We expect the ECB to be continuing their fight against inflation. If we just take a look at what's going on, look, you can see that ECB at 3%. Markets are expecting slightly higher interest rate, maybe one more hike, terminal rate, and then sort of flat for the rest of the year. So 69% chance of a 25 basis point hike for the 4th of May meeting. So not masses of difference from short-term interest rate markets, what the ECB is saying. But just to be aware, if we start to see any news that the ECB are pausing on rates, that would be negative for euro. So the best thing to look from ECB speakers, if they start talking about we're at terminal rate, we don't want to hike anymore, anything like that, the euro will be very sensitive to euro downside, because inflationary pressures, further ECB hikes is a well tried and tested narrative. Got Bank of England Governor Bailey speaking. Now, last interest rate hike from the Bank of England was a 50 basis point rate hike up to 25 basis point rate hike up to, what was it, 4.25, I think. Let me just check. Yeah, it's up to 4.25%. And interest rate markets are expecting one more rate hike this year with a 55% chance of another rate hike. Now, inflation in the UK took up another unexpected tick higher, 10.4 up from 10.1. So that was a concern for the Bank of England. But the Bank of England, at their last interest rate meeting, what they said is they still expect interest rates to fall. You can have a look at the Bank of England interest rate meeting, but they say we still expect inflation levels to fall. So that's where the Bank of England are. What we need to look, best opportunity would come if the Bank of England Governor Bailey says we don't want to hike anymore. Okay, that's the best opportunity that would come. And if we just take a look at the Monetary Policy Committee, their voting record, you can see at the March meeting last week, Dingra and Tim Rayo voted for no interest rate hike, and Mann, who sometimes can surprise, is very hawkish. Like previously, when the rest of the committee wanted a 50 basis point rate hike, she went for 75. She does sometimes really put her foot down in terms of higher interest rates. She was happy to move back in with the fold and go along with a 25 basis point rate hike. Dingra and Tenreo, they're very dovish members. So a couple of things to look out for. If Dingra and Tenreo turn more hawkish, that'll be pound positive. So that'll be like euro pound selling. So watch out for Dingra and Tenreo. If they say things like, we need to go higher than markets are expecting, inflation stickier, it's more of a problem, then that would be very pound supportive. And if we start seeing Catherine Mann talking about interest rate cuts, and thinking, we're at peak terminal rate, something like that, then that would be negative for the pound. So you look for euro pound potential upside. Now Bailey is sort of somewhere in the middle. You see he's sort of fairly neutral. Andrew Bailey, he's the Bank of England's governor. He is speaking later today. If he says anything very dovish, then you'd expect the euro pound pair to gain. So if he talks about we're at terminal rate, we don't want to hike interest rates, we're worried about growth, then look at euro pound upside. Another speech from Bailey coming up, RBA, nothing particularly to notice there. Consumer confidence out of the US. If that falls sharply, that plays into the recessionary fear, okay? So this comes in sub 95. That means the Federal Reserve will be less likely to hike interest rates. So that should be supportive for S&P 500 stocks. So a short-term tradable opportunity I'd be looking for here, consumer confidence underneath 95, expect short-term upside in the S&P 500. Why? Because US interest rates should go lower, because if the consumer is struggling, the Federal Reserve will be less likely to hike interest rates, and that is confirming that perspective that there is a US recession coming. If this comes in very, very strong, say it comes in above 104, then I expect some dollar upside. S&P 500 downside as a short-term reaction, but I would trade, if it's 104 higher, I would look at trading euro US dollar to the downside, okay, if it gets 104 or higher. Wednesday, got EIA crude data coming up. Now, just looking at oil stocks, you can see crude is trying to find a base around that sort of 67, 60 region. If you look on the monthly chart, what you'll see is that's an enormous support level, just coming in above this sort of, V-shaped bottom, got 100, 200 exponential moving average. We talked about going long here potentially, I think in the last meeting we had, just because technically it's a lovely area. Okay, I wouldn't join longs now. That's just finding a little. The last chance would have been that move into that support area. If you are long now, you're looking for a potentially retest of that 74, 75. And if we can get back above that 78 region, and if we get like a false break pattern here, you see here, if we have this closing back within that range or higher of February's candle, see if we close higher than 77, 76.82, and this closes the month positive, then we're looking for a retest up to 1995. Okay, if this closes below that level, that is more bearish. Okay, so we want to see oil push up higher. We probably will see stocks move higher because it's the round of the turn of the month, and around of the turn of the month, you tend to see stocks gain. So this is a positive time for stock markets. Oil markets, if we see a big draw in the oil stocks, So they're expected to find a build of 1.117 million. Sorry, a draw of 3.31 million was the last print. If we see another draw of inventories, expect oil to move higher. But markets are saying, you know, second half of the year, they're expecting to be a problem with oil. But at the moment, it's quite well stocked. So it's a bit tricky. Look out for the Tuesday private data that comes out. So Tuesday, we get the API crude oil stock change. And then that sets the tone for Wednesday. Though watch out, I tell you what's been happening recently on this API crude data. It's like the data's leaked. So whatever the print is, you tend to see them move earlier. So we had this 3.262 million build last week rather, and over again, oil stocks just move before the print. So if you start to see oil tomorrow morning just tanking, it probably means there's a build in the inventory. If you see it rising sharply, it probably means there's a draw. So, you know, just be aware of that. Bank of England, this is Mann speaking. So Catherine Mann, she is a hawkish member. So if she says something dovish, then look for euro pound upside. She's very hawkish, so unlikely to, but that would be the opportunity. ECB Schnabel, Bank of Canada's Gravel speaking. Now, Bank of Canada's interesting. If you just take a look at short-term interest rate markets here, they're expected to be at terminal rate now. So there is kind of expectations that they're going to cut by 25 basis points, 23% chance. So just watch out for any signs of a cut. If we see Gravel hinting about an interest rate cut, then look for CAD downside. And then you could see a US dollar CAD upside. Got some European CPI data coming up. German CPI, very important for the rest of the Eurozone. Got Germany inflation data, important. So again, high inflation means the ECB are more likely to hike, so that would be supportive of the euro. Low inflation means the market, you know, central banks will be less likely to hike interest rates. So that should be a cause of weakness for the euro. So look for out of consensus prints. Continuing jobless claims shouldn't be much. Core PCE, this is important. Okay, it's the Friday data we want, but that starts to set the tone for US inflation. Governor Michael speaking, had a hawkish tilt from the SNB at the last meeting on Thursday. They hiked by 50 basis points, and they projected that inflation is getting a little bit worse in Switzerland. If you just take a look, I'll just show you the, I might have this up here actually. Let's have a look. I was looking at this earlier. Yeah, you can see here the inflation outlook. All right, you see how they just revised up their 2023 forecast. So they now expect inflation for the third quarter of this year, they expect it to be 2.4%, up from 2.2%, and they expect end of the year to be 2.3%, up from 2%. Now, in 2025, they expect it to be the same again. But you see they're just upping inflation expectations. So they see higher inflation coming from Switzerland. That's hawkish, and that's why policy rates have been increased to 1.5%. Now, just look out for any kind of dovish comment from Maitler. So if we get the SNB governor saying, oh, okay, you know, we're confident we're winning the inflation battle, this might be the end of our interest rate hikes, then look for Euro Swiss franc upside. That will be the go-to pair. Chinese data, now this is important. How are the service sector doing as China bounces back from COVID? Stunning prints here. If we see very high prints here, that should be very supportive for overall stocks. But remember, we need to keep in perspective the banking stress and what's going on with the Federal Reserve. But this can lift sentiment on the day. So watch out for sentiment coming in very positive for China. That can lift the Aussie, and because of the close proximity of trade between Australia and China, what's good for the Chinese yuan is also good for the Australian dollar. Friday is going to be a very interesting day. We've got that Eurozone inflation data. Now, core, important, look, it's expected to tick up to 5.7. headline down to 7.2 from 8.5. Core has been quite sticky around the world. UK core inflation rising last week. Just take a look here at the core inflation. See, it's up from 5.8 to 6.2 in the UK. So if the Eurozone inflation goes up as well, particularly at the core, if the core comes in above 6.1, expect that to support the euro higher. Okay, inflation above 6.1 for the core year on year, and the headline, if that's above 8.5, then that's definitely more hawkish. So you expect the euro longs. Look at something like the euro pound would make sense, because the euro and the Eurozone and the UK are quite similar economic positions, quite similar place in the economic cycle. So trading one against the other makes sense for short-term tradable opportunities. Inflation data crucial on Friday. This is very important. So you can see the headline is expected to come in core PCE 5.4 down to 5.1. Now, the PCE is the Fed's preferred measure of inflation. So the Fed really pay a lot of attention to this PCE inflationary data. Just take a look here. PCE, core PCE. Where are we? Right, they're expecting it to come in at 5.4% was the prior reading, and they're expecting it to come in 5.1. So that's good. They're expecting it to fall, the lowest of the year. So that should keep stocks supported into the end of the week. Why? Because investors are expecting the Fed to need to do less, which plays into that pricing that there'll be more likely to be rate cuts than hikes. So if on Friday, if this comes in higher than expected, and that means if the core comes in higher than 5.4, and the year on year comes in higher than 4.9, then expect that to be negative for stocks, positive for the dollar, negative for gold. Okay, so that would be the go-to pairs to look at. If it comes in, if the headline comes in above 5.5 and the core comes in above 4.9, negative for stocks, positive for the dollar, negative for precious metals. If it's the other way around, say it comes in below 4.7 and the core comes in 4.7 or below, then expect that to be positive for stocks, negative for the dollar, positive for precious metals. Then we've got consumer sentiment. This is the final reading. We've already had the preliminary reading for March, so not expecting much of a reaction from the Michigan inflation expectations and consumer sentiment print, but it's worth being aware of, and ideally want it to complement whatever happens with the data points earlier. And then we've got Fed's Williams and Fed's Cook speaking. So we have, a full day on Friday. So the best day of the week, folks, is Friday. That is, I will be back on Wednesday, and on Wednesday I'll be getting us ready for that US core PCE print. So if you come back on Wednesday, I'll show you the trade plan, what I'm looking for, what instruments. It'll be a bit easier because we'll be there on Wednesday, and so we'll be closer to the event, and so some of the levels will be more relevant. Okay, folks, that's a whistle top start for the week. That should get us ready. Don't forget, banking news will be very important. And yeah, hi Gavin, great. Yeah, thanks. I'm glad. Yeah, thanks, Gavin. I'm glad you got the link. I just saw your email come in to support, and I thought, right, I think I can probably help with that. Glad you got here, Gavin. Let's have a look. Is gold going forward a possible long? A strong PCE could push it lower, then a possible rally could be on the cards. Yeah, look, now I saw this, Gavin, in gold. So, Gavin, I know you know the narrative very well here, which is when you have falling real yields and falling dollar, that's positive for gold. So what Gavin's really saying to those of you who are maybe less aware of this is, look, real yields are pushing lower, dollar's pushing lower, gold's really pushing higher. So even if we got like a snap lower in gold, is that a dip to buy? And the answer is yes, it is, right? So even if we've got a strong PCE, you'd expect gold downside in the near term, but does it change the long-term picture? Probably not, right? So yes, Gavin, you're absolutely right. a strong PCE, gold pushes lower, and you can buy it. That's legitimate, okay? And stop just underneath those recent lows. Now, one thing that I noticed on gold, and I was looking at this, where is it? Hang on, let me just get the right. There we go, right. I was looking at the Dongxin channel, great channel for using in commodity markets, okay? A lot of folks use this channel because very clear direction of when you buy and when you sell, okay? And basically what it is a breakout of 20-day trading range. So gold, if you look at it, is, you know, very, very much a buy, right? So any retracement down to 1890 is definitely a buy, Gavin. Yeah, stops sub 1790. So if we move down to here, 1890, 1900, say 1900, stops sub 1788, 85, yeah, it's a buy. All right, definitely. And you can manage your risk quite nicely, just underneath 100, 200 exponential moving average, latest swing point, trend line, you know, potential trend line moving from there. That's great. So stops sub 1790, buying from 1900 makes sense. And that's solid support, solid support, solid support. If you wanted to be like, no, that's it. That's where you have your stop. You wouldn't have it anywhere else, right? 1790, because if that gets taken out, something's wrong. That should hold. If the outlook is, yeah, definitely. So you look for that, right? That would be fine. And you'd at least expect to retest up to that 1950, 1960, you know, bounce, especially with real yields. As long as real yields are continuing to track lower, dollar continuing to track lower, right? That's positive for gold. Great, Gavin. Yeah, well, I'm glad you made it, even if it was just for that, right? Take care, folks. Look forward to being back on Wednesday. Thank you all very much for making the new time with the clock change here in the UK. We've now moved to British summertime. Hope you all have a very good week and look forward to speaking to you soon. Thanks, everyone, now, and goodbye.